Hello, everyone. This is Lonnie Matthews coming back at you again. This week we're talking about Chapter 3, so hopefully you've had a chance to read the chapter. Honestly, I'm assuming that you've read the chapter by the time you view this particular slide or video. It just makes it a little bit easier. So this week we're talking about the double entry accounting system. In other words, double entry simply means that each entry is entered in to two places. It's not entered in twice, it's entered in two places. Which leads me to the discussion about debits and credits. And for some of you, this is kind of new, probably for most of you, and even more so, it's backwards in some cases because you have learned that debits are bad things, and credits are good things as far as a bank is concerned. And that is true according to the bank. But for other things, it's not necessarily true. So we're going to jump right in. First thing I want to do is introduce you to T accounts, right? The T accounts, this is what we use to keep track of each individual account. Remember last week we talked about there are elements, assets equals liabilities plus owner's equity. We also, in your chapter reading, you can break owner's equity down to include capital, revenues, drawing, and expenses. So each one of those are elements or categories. Each category has several accounts underneath in some cases, and we use T accounts to keep track of those. So this is a T account, and the reason they say it because it looks like a little T here, and on the left side is the debit side, and on the right side is the credit side. In fact, the words debit and credits really just mean left and right in French, right? Because this was created by some Frenchman back in the 1400s. And it's also abbreviated debit credit. So that part doesn't change. Every account has its own debits and credits, and the debit is always on the left and the credit is always on the right side. Now what changes is whether an account is increased on the debit side or increased on the credit side. That's where it gets confusing. Just like our little guy here, it says an increase. Every T account has an increase side and a decrease side. Some accounts increase on the debit side, some accounts increase on the credit side. So what I want to do in this short presentation is talk to you about the 7 rules of debits and credits. I like to call them the 7 commandments, right? It's kind of like the 10 commandments, except there's only 7 of them. Because just like the 10 commandments, no one commandment is greater than the other, right? It's just you got to try to do them all. So no one rule is greater than the other. You just got to try to do them all, right? And make sure you don't mess them up. Because if you do, bad things will happen. Usually your accounting system will have some errors somewhere. All right? So let's dive in and go over the 7 rules of debits and credits so that you'll be ready to rock and roll on the discussion question. Rule number 1, assets. And again, this is all assets. All assets are increased on the debit side and decreased on the credit side. So that's where I mean by it's confusing, because when you go to the bank and say, I want to use my debit card, that means they're taking money away from your account when they debit your account. The truth is, assets such as cash is an asset, are increased on the debit side. So they're a little bit backwards when it comes to the bank is concerned. So rule number 1, all assets, no matter what they are, whether it's cash, accounts receivable, equipment, whatever, is all increased on the debit side. All right? Now, next thing, rule number 2, excuse me, is every transaction, debits must equal credits. In every transaction, the debits must equal credits. So basically, you can't have a $400 debit and a $200 credit, right? Now, if you're going to do something like that, you need at least 2 credits to equal $400 or something, right? Something along those lines. I apologize. So rule number 2 simply says that your debits must equal the credits. So you can have more than one debit or more than one credit in an individual transaction. That's called a compound transaction. But the value of those debits must equal the value of the credits at all times. Otherwise, my accounting equation will be out of balance, and we don't want it to be out of balance. Remember, that equation has to be in balance. And it also means when you're looking at the accounting equation, if you do something to one side, you have to do the same thing to the other side, right? So if I, in other words, debit the asset side, which makes the asset side go up, I mean I need to do something on the other side to make that side go up as well. All right. So in every transaction, you have to have a debit, and you have to have at least one credit in every transaction, and the value of those debits must equal the value of the credits. Not the number, but the value. Okay? The drawing, so that's rule number 5. How did I get so far on number 5? Oh, wow, I skipped a long way. That's rule number 2. Let's find rule number 3 here real quick. Rule number 3 simply says that liability accounts are decreased on the debit side and increased on the credit side, right? So now we're starting to see the opposite effect here. Liabilities are increased on the debit, decreased on the credit. So that kind of works, right? I'm sorry, decrease on the debit, increase on the credit. That kind of works. Let's say in that same example, let's say we go borrow some money from the bank, right? The bank is going to give us some money. We're going to put it into our checking account. The checking account is our cash account on the asset side. So that means the cash account is going to be increased on the debit side for $500. That means we're going to add the credit side on the other side of the equation, and it needs to go up by $500. So then here we go. We got the credit for $500, and we're still in balance, right? So that's rule number 3. Rule number 4, the capital account is increased on the credit side, decreased on the debit side, just like liabilities. The capital account is used when an owner invests cash in the business, right? So if I borrow money, that's a loan. It's a liability. If I put money in the account from my personal account, that is capital that the owner is investing in the business, right? So we would increase on the credit side, decrease on the debit side there as well. That's rule number 4. Rule number 5 says that the drawing account looks just like the asset account because it's increased on the debit side, decreased on the credit side, right? So anytime I withdraw money from the business, I'm going to debit the drawing, and then I have to credit my cash, right? Because the cash is going to go down, and it's on the other side, right? Now, the next thing, rule number 6, is my revenues. Now, revenues are when I do something to earn money. I like to say when I do what I do, it's called a revenue. When I do what I do, it's called a revenue. So whenever I earn money, I'm going to increase my revenue account by putting it on the credit side. I'm also going to increase my cash account by putting it on the debit side, right? So again, I got a debit and I have a credit for every transaction. Every single transaction must have a debit side and a credit side. And the value of those debits must equal the value of those credits. Now, you can have more than one, but they have to be the value the same, okay? All right, so that's rule number 6. And lastly, rule number 7, my expense accounts are increased on the debit side and decreased on the credit side. By now, you have read that expenses, they increase, but they have a decreasing effect. So every time I increase the expense account, I'm actually decreasing the owner's equity account, right? So that means if I paid out cash, I'm going to credit cash, and I'm going to debit my expenses. That means my cash going down on that side. Also, my owner's equity is going down on this side. Although the expenses are going up, the owner's equity section is coming down because expenses make the owner's equity section come down. All right? So now, those are the 7 rules for debits and credits. I wanted to take a few moments and kind of cover those with you. The last couple things is, once you have gotten all of your accounts, you've used them. So here's an example of our cash account, right? We need to foot and total. Foot simply means to total, right? But we're trying to determine, what we're trying to do is trying to determine how much is in this cash account at this moment. So we're going to do that by balancing both sides, and then we're going to find the difference between those two accounts, the debit side and the credit side, and it's saying that I have a $370 balance. But the question is the $370 debit balance or credit balance? Well, here's the rule. The balance goes on the side of the account that was the highest in the first place. The highest. So in other words, this cash account we can see now has a debit balance of $370, right? So that are the rules for debits and credits. Hope you got something out of this presentation. So now you are ready to go and participate in the discussion portion of the course by answering the questions. So thank you so much. Certainly appreciate it.